Hey everyone, this is a video reply to some of the comments that I've received through my two videos that I made on how paying your first mortgage off faster by using a home equity line of credit does not work. Now, the average watch time on my 45-minute video is only 9 minutes, and I know viewers are probably missing lots of bits and pieces of necessary information. So I'm going to show you the clip from the conclusion of this video first. Yes, I'm about to show you the end first. Then, if you're interested in how I arrived at my conclusion, you could watch the full video. That way, that'll save you some time for those you busy folks here. All right. Now, I also have some bonus information at the end for the fans of using a HELOC to pay your first mortgage. I'll show you a situation where it just might benefit you. So stay tuned. All right, class, here we are at the conclusion. Now, this is not a matter of me being right and somebody else being wrong or vice versa. This is simply my conclusion based on 4 to 5 months of gathering hard data and my experience in the industry. So here we go. So the claim by the proponents of this idea here, number one, a HELOC is simple interest and a first mortgage is amortized interest. Of course, I showed you, demonstrated that no, both first mortgages and HELOCs are simple interest. Amortization is a method of structuring a loan. Simple and compound are forms of interest. In fact, I didn't mention in there, but if you watched my other two videos, you saw the epistemology on the word amortize, it actually was one of the early terms to describe making installment payments. It's not a form of interest, but anyway. The next claim is that the interest on first mortgages is front-loaded. And of course, you saw in the demonstration that no, that's just a misunderstanding of how the amortization schedule works. All right, number three, you receive additional interest savings on a HELOC because it accrues daily. Oh boy, this one here, one of the most misunderstood ones. And of course, I showed you, no, you pay interest on every day that you have a balance on that HELOC. The interest doesn't get waived. And, so you know that one. That was a easy one kind of to describe, but it's one of the most misunderstood things. All right, finally, claim number four, that you increase your liquidity position by using a HELOC as a checking account instead of a checking account as a checking account. Well, boy, one of the really cool things about my job over the past 25 years is that I've got to meet people from all walks of life. Unfortunately, people just barely getting by and big ballers. I've met a lot of these multimillionaires and these hugely successful real estate investors with, 20, 30, 40 properties. And one of the things that they all told me and do is they have one or two HELOCs on the side just for emergencies or business opportunities. They don't use it as a checking account. They use checking account as a checking account. In fact, I've got one investor that had one checking account for each property. Anyway, they don't use a home equity line of credit. One of the big reasons is because, it's not true liquidity. The banks could yank that at any time, like they did on me back in 2008 and 9. They did on a lot of people back then, and they also did it during the uncertain times of COVID. They can shut that anytime that they see that they're at risk. They can shut those HELOCs down at their discretion, and then you lose all of your liquidity. So I'm taking it from the successful people. I use my home equity line of credit. I just keep one just in case business emergencies and possible business opportunities. All right. So now that I've given you some potentially bad news to some of you, how about I end this on a positive note with a little bit of potentially good news for the fans of using a home equity line of credit to pay your first mortgage off. Check this out. All right, so that was my conclusion towards the end of the video. If you'd like to see how I arrived at my conclusion, I now present to you the full video. All right, so here are the claims made by the proponents of this idea. All right, number one, a HELOC is simple interest and a first mortgage is what they are calling amortized interest. Number two, the interest on a first mortgage is front-loaded compared to that of a HELOC. Number three, you receive additional interest savings on a HELOC because it accrues daily. And number four, that you increase your liquidity position by using a home equity line of credit as a checking account instead of a checking account as a checking account. All right, couple quick notes. This video is not about using a HELOC to pay off consumer debt. Using a first mortgage or a HELOC to pay off consumer debt, especially credit cards, can have huge benefit, have wonderful results if done properly. But that's material for another video. And point number two, this video is not about using credit cards to pay off debt or assist with paying off your mortgage. All right, I will be your instructor for this video. I am a mortgage loan originator licensed with the California Department of Real Estate and the Florida Office of Financial Regulation. My credentials are registered with the nationwide mortgage licensing system. I've been working in the mortgage industry for over 25 years and have held various positions to include sales manager, branch manager, general manager, and now I own a mortgage brokerage. I've taught both private and public classes on this material. And of course, my favorite food is my mother's gumbo. Let's go. All right, class, look, I've got a ton of links in the description of this video, so you can do a third-party verification of all the information I'm giving you so that you can see I am definitely on the up and up. All right, class, let's kick it off with the fundamentals. Types of interest, methods of accrual, and loan structures. All right, simple and compound are types of interest. Daily and monthly are methods of accrual. Amortized and non-amortized are loan structures. So types of interest impact how much you pay. Methods of accrual account for how much you owe. And loan structures determine how you pay it back. So we've got types of interest, how much you pay, methods of accrual, how much you owe, and loan structures, how you pay it back. Now, these things are independent, totally independent, but they can work together. For example, you can have a simple interest loan that accrues daily and is amortized, or a simple interest loan that accrues monthly that is non-amortized, or whatever combination that you're going to do. But they are independent things. So if you were to compare something like a type of interest to a loan structure, that is the proverbial apples to oranges comparison, or bananas to Ford pickup trucks. You can't do that. But unfortunately, that's something that's done a lot. All right, next topic. All right, class, I want to take just a little over 90 seconds to highlight on two features of the home equity line of credit. So that first feature is interest only. Interest only is a feature that allows you to defer paying on the principal balance for a limited period of time in order to give you a lower payment. Interest only is a feature that's available on both first mortgages and home equity lines of credit. On first mortgages, they have like 3-year, 5-year, 7-year, and 10-year interest only options. They also have 30-year fixed loans with a 10-year interest only option. So it's not exclusive to home equity lines of credit. But let's talk about the home equity line of credit one. So this is one where you can pay the interest only for 10 years, and it's a total of 20 years on the loan. The last 10 years are reserved for payback. There are also options like the type I have at my company where it's a 10-year interest only period and I have a 20-year payback for a total of 30 years. But anyway, let's talk about this one. So as you can see, when you come down here, the interest payment is $364.58. So that's the total interest due, $364.58. And notice how the balance stays the same as you go down the schedule here, because you're just paying interest only. It still stays at $50,000. Now, reason why I'm touching on this, because a lot of people confuse interest only with simple interest, two different things. Interest only is a feature. Simple and compound are forms of interest. All because a loan has an interest only option doesn't mean that it's simple interest. So if you come down here, I want to highlight on the second feature, which is at the 11th year. Notice how the payment changes. Now the minimum payment changes to $626.63, and now you see the principal starting to go down. That's because it turns into a fully amortized loan on the 11th year. So the last 10 years are designed for payback, so it has to be fully amortized. So on the last payment, it pays off in full. Hence the name, fully amortized. And as you come down to payment 240, you'll see it gets to a zero balance. So those are the two features I wanted to touch on for on this home equity line of credit. Let's get back to the rest of it so we can finish up. Hey class, we are on amortizationschedule.org. I'm just going to do a 2-3 minute really quick review on this because I covered this in detail in the long video. So we're going to use a $400,000 loan amount, a 6% rate, And this is going to be a 30-year fixed rate loan. Let's go ahead and come on down to the schedule here. All right. So after the first payment on the $400,000, you can see the remaining balance, $399,601.80. This is the fixed monthly payment of principal and interest, $2,398.20. And then out of that $2,398.20 payment, $2,000 went towards interest. And the remaining balance on here of $398.20 went towards principal. So how did that figure come to be? Well, it's a simple calculation. That's why they call it simple interest. Take $400,000, the loan amount, multiply that by 6% equals $24,000 for the year. Divide it by 12 to get the monthly, and you've got $2,000 interest. And looky here, $2,000 interest. If I just go down the line here really quick, do the next one, $399,601.80, on the remaining balance here. Multiply that by 6% equals 23,976. And I divide that by 12 equals 1998,009. I rounded up to 1 penny. And look what you have here, the same amount of interest. And this happens all the way down the line here. I can go down to any random payment here. Let's see, whatever, 122,000. How about this one? $122,270.39. So I'll do $122,270.39 times 6% equals $7,336.22. Divide that by 12, and I've got $611.35. And looky right here, $611.35. So do you see what's happening now? The smaller the balance, the less interest you pay. The larger the balance, the more interest you pay. That's what gives the illusion of front-loaded interest to the uninitiated, to folks who don't know this, which most people. And to be all honest with you, when I first got into this industry 25 years ago, even after my training, this threw me off also. So I can understand how it looks like front-loaded interest, but it's not. It's a simple interest calculation. It's you're paying more interest in the beginning because the balance is bigger. The way around this, make extra principal payments so you can jump down and pay on a lower balance as soon as possible. And that's what this is all about. Let's go ahead and jump on to go over to the next topic. Hey class, we are going to do a quick daily interest exercise. So in this exercise, our proponent has a first mortgage and he or she is going to draw $15,000 on their line of credit to chunk towards the first mortgage. The home equity line of credit interest rate is at 8.5%. Let's get into it here. Okay, so the balance on the first day that it was drawn out, $15,000, the amount of interest due is $3.49. So the balance is the same for the next day. So it's $3.49 here, $3.49 on the 7th, $3.49 on the 8th, $3.49 interest due on the 9th, and on the 10th, the paycheck comes in. So this person here gets $5,000 a month. So here is half of that being paid on the 10th here, $2,500. So we subtract that $2,500 from the $15,000 balance because this paycheck is getting dumped into the HELOC. So that takes the HELOC balance down to $12,500. The daily interest due, $2.92. All right. So same thing for the following day, $2.92 on the 12th, $2.92 on the 13th. On the 14th, the mortgage payment comes due, the principal, interest, taxes, and insurance of $2,600 on the mortgage. So that's added to the home equity line of credit because it's paid with the home equity line of credit. So that takes the balance to $15,100. The interest due on that amount is $3.52. So same thing for the next day, $3.52. Same thing for the 16th, 17th, 18th, 19th, 20th. 21st, 22nd, coming up here on the 23rd, same thing, $352. And then on the 24th, 2 weeks later, the other paycheck of $2,500 comes in. That gets dumped into the HELOC, but bills are due on this day. So we've got $600, and that's going to be, so say this person has paid all of their bills off, no car payments and things like that, no credit cards, just only like living expenses and utilities. So we've got water, gas, electricity, phone, automobile insurance, food, of course, that off with and they say they don't have cable, say they're doing something, they're living lean, they've got like Netflix and Hulu. So $600, that takes the balance up to 13,200. So the interest due on that day is $3.08. So we're at the end of the billing cycle, $3.08. But as you see, the show still goes on because there's still a balance on there. But on this billing cycle, this is going to be billed from the 5th till the 25th when the billing cycle closes. So all those are added up, and that's the bill that you're going to get on the 1st. So as you can see, even though payments were made on this, it didn't pay it off completely. So there's still interest due. For every day that you have a balance on your HELOC, there is interest due. You don't get a break for making the payment. You still have to pay it. The only way to get out of paying interest is if you pay the $15,000 in full. All right. So now check this next thing out here real quick. All right, class, this is directly from Experian's website. I have a link in the description of this video, but let me read it off to you. Best way to avoid interest entirely is to never borrow money. But that's not feasible for many people, so it's important to know how to minimize your interest costs. If you have a credit card, you can avoid interest by always paying your monthly bill on time and in full during the grace period. Also, avoid cash advances, which start accruing interest immediately. With other types of credit, including mortgage loans, auto loans, student loans, and personal loans, interest is unavoidable. So it's like I was telling you, if you have a balance on that home equity line of credit, you're going to pay interest on it. All right. So let's move on. All right, class, here we are at the conclusion. Now, this is not a matter of me being right and somebody else being wrong or vice versa. This is simply my conclusion based on 4 to 5 months of gathering hard data and my experience in the industry. So here we go. So the claim by the proponents of this idea here, number one, a HELOC is simple interest and a first mortgage is amortized interest. Of course, I showed you, demonstrated that no, both first mortgages and HELOCs are simple interest. Amortization is a method of structuring a loan. Simple and compound are forms of interest. In fact, I didn't mention in there, but if you watched my other two videos, you saw the epistemology on the word amortize, it actually was one of the early terms to describe making installment payments. It's not a form of interest, but anyway. The next claim is that the interest on first mortgages is front loaded. And of course, you saw in the demonstration that no, that's just a misunderstanding of how the amortization schedule works. All right, number three, you receive additional interest savings on a HELOC because it accrues daily. Oh boy, this one here, one of the most misunderstood ones. And of course, I showed you no, you pay interest on every day that you have a balance on that HELOC. The interest doesn't get waived, and so you know that one. That was a easy one, kind of, to describe, but it's one of the most misunderstood things. All right, finally, claim number four, that you increase your liquidity position by using a HELOC as a checking account instead of a checking account as a checking account. Well, boy, one of the really cool things about my job over the past 25 years is that I've got to meet people from all walks of life. Unfortunately, people just barely getting by and big ballers. I've met a lot of these multimillionaires and these hugely successful real estate investors with 20, 30, 40 properties. And one of the things that they all told me and do is they have one or two HELOCs on the side just for emergencies or business opportunities. They don't use it as a checking account. They use checking account as a checking account. In fact, I've got one investor that had one checking account for each property. Anyway, they don't use a home equity line of credit. One of the big reasons is because, well, it's not true liquidity. The banks could yank that at any time, like they did on me back in 2008 and 9. They did on a lot of people back then, and they also did it during the uncertain times of COVID. They can shut that anytime that they see that they're at risk. They can shut those HELOCs down at their discretion, and then you lose all of your liquidity. So I'm taking it from the successful people. I use my home equity line of credit. I just keep one just in case business emergencies and possible business opportunities. All right. So now that I've given you some potentially bad news to some of you, how about I end this on a positive note with a little bit of potentially good news for the fans of using a home equity line of credit to pay your first mortgage off. Check this out. Folks, you got the power, extra payment power. And this is a trip. It surprises me how many people don't know how many homeowners that who have mortgages don't know the power of extra payments. Right there in the palm of your hand. So check this out. So if you made just one extra payment per year on a $400,000 30-year fixed loan with a 6% interest rate, you would cut about 6 years, like you can read here, and save over, and that's 6 years off the loan. Imagine that. 6 years of no interest, 6 years of no payments, 6 years off the loan, and save over $99,000 in interest. The figure is so big. A lot of people, it's kind of surreal. They don't really even believe it, but it's true. $99,000, one extra payment per year. And then, of course, like I put here, the savings are utterly amazing if you make more than that. And then, of course, you can do this in conjunction with lowering your interest rate. Like on one, I did switching over to biweekly. I'll do a separate video about that. Biweekly amounts to one extra payment per year. And so switched over to biweekly and dropped the interest rate 0.5% on a $500,000 loan, knocked 8 years off the loan, just 0.5% and switching over to biweekly. 8 years. That's huge. All right. So why am I mentioning this? Because I've had several people, well, more than several people approach me and tell me, hey, I was paying my home equity line of credit doing this, velocity stuff and using a HELOC to pay it down. And we paid it down quicker and we got some great results from it. And I'm like, I didn't disagree with them. I was like, oh yeah, great. I says, well, in the process of doing that, did you make extra payments, extra principal payments against your mortgage? And of course, every single one of them said yes. And I said, well, it wasn't the power of the HELOC that did it. The HELOC didn't save you any extra interest, as you saw from the video. It was the power of those extra payments. It's redonkulous. People, and I'm so surprised that people don't know how much. Now, why am I saying this? Because I've seen it and I've learned from these successful people. A lot of them follow a system, and it's all about following a system. Because, like for me, I don't like doing biweekly payments. Biweekly payments is a great way to make extra payments, because don't confuse biweekly with bi-monthly. Bi-monthly just results in two extra payments per month. That's 2 payments per month. That doesn't do anything extra. Biweekly is 26 pay periods, and that results in 1 extra payment per year. That's why that works. But that doesn't work for me. What worked for me is adding a little extra on. In my case, it was $250 on per month, amount that I can forget about. And I had it automatically paid, so I just forget about that extra $250 I added on there, after a period of time. I forgot that it was even going on. That system works for me, but that might not work for you. And biweekly might not work for you either. Other people use a system where they chunk it down once per year. Like they'll use a bonus that they get from work. I see a lot of people do that, and they apply that bonus towards the mortgage. And other people use their actual tax refund for that. Whatever the system is, if you have the intent of paying your house off, whatever works for you that you can keep and do consistently, it works. So with this whole using your home equity line of credit to pay a first mortgage, well, while there's no interest benefit in there, in fact, if you have like I've shown before in one of my other videos, if you have a balance on both loans, you're actually paying interest on the HELOC and the first mortgage. But if through the course of doing that, that helps you make extra payments, well, hey, it works. It's successful. If that helps you, if that's a system that you like and you can stick with it, even if the HELOC doesn't save any interest, it's something that helps you make extra payments, well, then mission accomplished. Because again, if you're a homeowner that wants to pay off your home, the two keys are extra payments and keep getting your interest rate as low as possible, with the emphasis on extra payments. So yes, that's a situation where, the system works. And I know it may sound a little hokey balokey, but I believe in the whole system thing now. I mean, it's kind of like even with Mr. Ramsey, Dave Ramsey. Now, he's created a system, and well, as a mortgage person, to be quite honest with you, I've seen a number, advice, a number of pieces of advice that have come from the show that as a mortgage person, I just can't agree with. But he makes it easy when you follow the system. Sure, the system doesn't apply to everybody, but it's an easy system to follow. So it works for a lot of people. And, so if that works for you, using a HELOC that way, works for you to get an extra payment in there, even if it doesn't save any interest by fact of using it, if it helps you make an extra payment, hey, then I guess mission accomplished on there. All right. So I hope this whole video was helpful to you. I've got to get on to making some other videos. That's why I created this response video, because I've got to go make some other material other than stuff on using a home equity line of credit to pay the mortgage. So this will probably be my last video on this, unless, I get enough requests for details on something additional. Otherwise, you know what? Y'all take it easy, and I will see you on the next one.